The Department of Justice is now probing valuations at a BlackRock private credit fund, and that sentence should stop everyone cold. Not because BlackRock is going to disappear, it is not. Or that a probe means that BlackRock has done something criminally wrong. That is not necessarily the case. Nothing has been proven. However, the biggest problem in private credit is what they are probing. Valuations. There have been significant questions about valuations, and this just took everything up a whole notch or 10. The question everyone needs to ask is how much are all these loans we have been talking about actually worth, and who gets to decide, and what happens when investors and banks, regulators, and now possibly prosecutors stop taking those marks on faith. That is the real story. Not one BlackRock fund. Not one Blue Owl buyback, not one Carlyle dividend cut, not one so-called problem fund at KKR or Apollo. The story is that the private credit cycle is moving deeper into the part where trust really starts breaking down. And once the issue becomes trust, the problem is no longer just about credit losses, it becomes funding, it becomes collateral, it becomes withdrawals. It becomes banks pulling back and insurance companies reassessing their exposures. It becomes the credit crunch. And we have got yet another cluster of stories on the private credit bus, which all point, of course, in the same direction toward escalation. So we have got the DOJ probing BlackRock. We have got troubled funds at Apollo and KKR, Carlyle BDC cutting its dividend, and of course it could not be a day that has gone by without another story about Blue Owl. This time management is buying back 85 million in shares. This is a pattern. It is a pattern of what stage 2 actually looks like. Now, the reason the BlackRock story matters so much is because private credit depends on a simple promise. And the promise is do not worry about daily market prices. These loans do not trade every second like stocks. They do not have the same price discovery as treasuries or corporate bonds. Maybe leveraged loans. That is supposed to be a feature, not a bug, private credit managers tell investors, because these assets are private, because they are held to maturity. They are not being constantly repriced by panicky markets, so investors can earn stable returns without all the volatility. And during the upswing of the cycle, that sounds fantastic. High yields with low volatility and limited defaults. Even some diversification, driven by direct relationships with borrowers. Senior secured loans that are held to better covenants and less mark-to-market noise. That was the pitch. But the other side of less mark-to-market noise is this. If there is no active market price, the fund manager has to model the value. And once stress begins to rise, that model becomes an entire game. Because if the model says the loan is worth 98 cents on the dollar, the fund net asset value looks fine, but if the market would only pay 80, that is a completely different story. And if banks lending against those assets start thinking the real number is also 80 while the fund is still saying 98, that becomes a funding problem like we have talked about. And if investors think the real number is 80 while the fund still says 98, that becomes the redemption problem. And if regulators think the real number is 80 while the fund still says 98, that then becomes an oversight problem. And if the Department of Justice is asking questions about valuations, it is already becoming something else entirely. Again, no wrongdoing has been proven. We are not saying there was fraud. Though there had been fraud in the past, we are saying that this is the precise fault line that critics have been warning about for years. One of private credit key weaknesses is its opacity. And the reason it is a weakness is simply because of, as we know only too well, bubble behavior, garbage lending, therefore the potential for serious losses, and now that opacity is really being tested as we get even more signs pointing to and only ever pointing to more trouble always in that same direction toward escalation. Now what Bloomberg reported for BlackRock was that the Department of Justice may be investigating valuations and valuation techniques at the same BlackRock fund that we have been talking about for the last little while here, at least a couple of months now. And this is a major development not because BlackRock is some fringe player, exactly the opposite. BlackRock is the biggest asset manager in the world. It is as mainstream finance gets, and that is what makes this so important. For the last year or so, private credit defenders tried to explain every problem away as just some isolated case. One borrower isolated, one bad loan, a BDC that is trading at a huge discount over emotional investors, one fund that is gating its withdrawals, that is not representative of the entire industry. A lender using too much payment in kind that is just normal. They have said, but once the concern reaches a BlackRock fund, the isolated argument gets harder to maintain. It means the valuation question has moved from critics and short sellers and skeptical investors into the regulatory and potential law enforcement spotlight, and that matters again. I am going to say it again, because valuations are not just some accounting matter. Valuations are the foundation for everything else that follows. They determine reported performance and fees. They are where investors feel comfortable staying in the fund, and if new money comes in, either from big investors or from banks. In private credit, the mark is the story, and the entire private credit boom was built on the idea that those marks were reliable enough to trust. So the question now is not what if investors stop trusting them. It is how far has this mistrust already gone to the point that it could see the inside of a courtroom. And remember, as I talked about last week, this is not the only legal drama surrounding the bubble. Blue Owl being sued by an investor who is alleging the exact same thing. Valuations. What is a Eurodollar University membership? It is where understanding the monetary world is not a mystery. It is a method. If you are serious about your financial education and you want clarity in a world of volatility and misunderstanding, this is for you. Mainstream education has left so many gaps on the most foundational concepts. Making sense of everything is practically impossible otherwise. With our memberships, we will fill in everything that you have been missing. Whether you are starting out or sharpening your edge, our memberships scale with your goals at Eurodollar University. We teach you about how money really works so that you can evaluate fundamentals and make grounded decisions. With a Eurodollar University membership, you get a comprehensive library of foundational and advanced lectures, in-depth case studies, and real-world analyses, live Q&A sessions, regular updates on macro trends, and even some central bank policies. And most important, how to interpret critical derivative market signals you will not find anywhere else. You cannot be in position to succeed if you do not know how it all really works and fits together. So, if you are ready to explore and master monetary systems, both past and future, with structure, clarity, and confidence, click the link in the description to visit the Eurodollar University website to join us today. This is why a lot of people call it mark to myth, because in public markets there is at least a price. There is price discovery, and it is public price discovery. You may not like the price, but it is there, and it is established by what we reason to believe is a fair market process. I mean, you can say investors are panicking or overreacting, but the price is the price, and you can see it like everyone else does. But in private credit, especially for loans that do not trade, the value depends on models, assumptions, comparisons, appraisals, internal processes, black boxes, and in some cases maybe some third-party valuations during good times. Bubbly times, nobody cares. If the borrower is paying cash, if defaults are low and investors are receiving their distributions, and if the economy behaves somewhat like it might actually be strong and resilient, then everyone is willing to just go along with everything. But during the downside of the cycle, the assumptions matter a whole lot more, which is, as I pointed out last year, why the negative payroll reports were so damaging. Damaging to trust about these assumptions, especially if a borrower is no longer paying cash interest and instead interest is being paid in kind. Is that loan still worth par if the company has to extend its maturities because it cannot refinance? Should the value be close to 100 if the borrower earnings are weakening with the economy, but the fund says the collateral coverage is still fine? How should investors trust that? And if similar loans in the liquid market are trading at lower valuations, why is the private loan still marked close to full value? These are not theoretical questions any longer. They are questions now sitting right at the center of the private credit story, and the BlackRock probe is important because it validates that concern, not the conclusion. It validates the concern, and the concern is, are private credit funds marking assets in a way that reflects economic reality? Or are they marking assets in a way that delays recognition of losses? And that, my friends, is the entire ballgame. And if it was only that, I mean, that would be a huge thing anyway. But as I said in the introduction here, we have got a whole raft of stories coming in on private credits fast and furious all over again. So we got DOJ investigating BlackRock. There is problems with Apollo and KKR funds that both of those big asset managers are trying to tackle. And again, look at the names. We have got KKR, Apollo, along with BlackRock. These are not tiny managers at the edge of the market. These are the core institutions of the private markets machine, and this is the part of the cycle where the issue stops being, hey, did a few bad actors make some bad loans? And it starts to become how much of the boom really was built on assumptions that only worked while the money was easy. During the boom, private credit managers were raising capital hand over fist. Pension funds wanted higher returns. Insurance companies, they craved yield. Wealth managers, they wanted alternative products to sell. The Japanese, the carry traders, rich individuals wanted institutional-style income, and banks. Banks were pulling back from certain lending markets, especially after the banking crisis in 2023. But that is where private credit stepped in. And so for a time there, everything seemed to line up. But when everyone is trying to deploy too much money into the same kinds of loans, you know where this goes.